Hi, I'm Seth Freudberg. I am the Director of Options Trading here at SMBU in Manhattan. I'm also the head trader of SMB's Options Trading Desk. So I'd like to talk today about the timing of trades, the timing of market neutral positive theta options trading, and whether it's a good idea to bunch them all up and start them all at the same time if you're going to do 2 or 3 or 4 or 5 strategies, or whether they should try to spread them out over time. My argument would be there's lots of different ways of diversifying your trading portfolio, and one of them is time. Probably, you could argue, for market neutral income trading, the most important diversification is time. And so the last couple months and this huge rally we've had since the market bottomed in February of this year will offer a very good case in point for this topic. So let's go back to February 12th, 2016. When the SPX was sitting at about 1850, 1849 in the morning on February 12th, which happened to have been 60 days out from the April monthly options expiration cycle. Let's go to 30 days from the monthly options expiration cycle for April, and that took place on March 16th, 2016. The S&P had rallied 167 points over that roughly 4-week period. And therefore, let's just think about it for a minute. When you put your options trades on all at the same time in connection with a particular options expiration cycle, you can get caught up in a situation like this, and it can be ugly. Bunching your options neutral trades into the same start date can be problematic, especially when the market is moving a lot. Regardless of the option strategy, whether it's a calendar, a butterfly, a double diagonal, a condor, whatever is your neutral strategy of choice, starting them all on the same day, if you have a bunch of different strategies that you execute, can be problematic, and I'd recommend against it, so that you can get some time diversification into your market neutral options trading. So how would you choose which strategies to start when optimally? Because once you've accepted the proposition that if you had started all your trades 60 days out from the monthly April options expiration, that could have gotten ugly. How would you spread these trades over time to make it a little bit more diversified? And I would suggest that you have to look at the time decay of options to figure out that answer. So let's look at the money options for a moment. At the money options will decay very slowly, 120 days out, 90 days out, and 60 days out. But once you get to 30 days out, you can see from this illustration that at the money options begin to decay very quickly, and the rate of change of that decay gets a lot higher as you get into the last 30 days. In other words, you have much more decay going on in the last 30 days for at the money options, whereas out of the money options actually decay all the way along. Every option that you're short is going to decay, or every option period decays as a result of time premium a little bit every day, but there is a deceleration of the way out of the money options in the last 30 days, suggesting that most of the party is over in terms of time decay for out of the money options in the last 30 days. And so what does that suggest in terms of when you should start which kinds of strategies? So here's a way that I like to look at it, which is trades where the options are short, way out of the money. You should start those 7 to even 10 weeks. I know some people who will do 10 weeks or more out from the options expiration, and that way you get to take advantage of the more accelerated portion of the decay of the out of the money options. As for the last 30 days or so, let's say the last 4 to 5 weeks, better to put on the trades naturally which have the quickest time decay during that time frame, and that would be the at-the-money strategies. An out-of-the-money strategy might be a high probability iron condor, the classic condor where you're starting out at 10 delta or lower on your short strikes, and you keep it on for until you earn a reasonable amount of the credit. On the other hand, 4 to 5 weeks out, you might want to consider putting on a at-the-money butterfly or an at-the-money calendar, because both of those trades, if centered at the money, you're going to get the most time decay from those. Now, this is all other things being equal. So if you think about what I just said, if you have your trading capital and you're looking to spread it across, say, a 2-month period, you may want to think about doing the well out of the money short option oriented trades 7 to 10 weeks out, and the shorter term 4 to 5 week trades, think about doing those at the money within the last 4 to 5 weeks before expiration. That way you will get the sort of the best of both worlds in terms of time decay on those various trades. So again, the most important takeaway from today's video is that spreading your trade capital across time frames relative to expiration is a good idea. That way you don't have all of your capital stuck at one particular price point in the market, and then if the market makes a giant move like it just did, you don't have such a large drawdown. Instead, you may have, in the case of the last 2 months, you might have had a much larger drawdown on the trades you started 60 days out, perhaps less of a drawdown, or maybe doing reasonably well on the ones that are only 30 days out, and that's because you did some time diversification thinking in your strategy and in your capital allocation. So I hope that helps you to think through time diversification on options trades, and we'll see you next week. Thank you.